You're listening to the Spicy Dividend.
What is up, everyone? This is Scott with the Spicy Dividend Podcast. Hope everyone is enjoying their Tuesday right before Thanksgiving, right before I put on another 10 to 12 pounds of water weight. It has been quite a fattening November, and it's going to continue this week. I hope everyone is going to have a great holiday, and everyone has something to be thankful for. So keep in mind what exactly you are thankful for, and keep everything in mind that you're thankful for. So today, going to be a little bit special of an episode. If you are into sports, I think you're really going to love this podcast segment. I have a pretty good analogy that I want to go for the first segment of the podcast. It might drag on for a little bit. We'll see. But should be a good one. Should be interesting. We'll get back to regularly scheduled program after I do the sports analogy. And I hope y'all enjoy the episode. Let's get into it. And they're off. Alrighty, so anyone who watches the NFL, National Football League, right, knows that Lamar Jackson, quarterback for the Baltimore Ravens, absolutely tearing it up. He's having an MVP caliber season, probably the front runner, at least according to Vegas odds, is the front runner to win MVP if he keeps up these type of numbers. Yesterday he threw for 5 touchdown passes, had almost a perfect passer rating. He might have had a perfect passer rating, I'm not sure about that. And he also had like 100 yards rushing for a quarterback. That's very impressive. He's having an amazing year. So a lot of people thought coming into the NFL that he would not be that successful. He was very mechanically flawed in terms of throwing motion, how he threw the ball. There was no touch on the ball. Very line drive-esque. He didn't release it right. It would spin funky a lot of times coming out of his hand. And then there was also the critics saying he runs too much, he scrambles too much, he's not big enough to take those kind of hits. All it could take is one big hit and he's out of the game. He's a project quarterback. He is not NFL caliber. Where are we getting with this? Well, he turns out to be doing pretty damn well. And what those critics will say now is that, well, you got to look at what Baltimore's doing. It's all part of a system, right? He is a system quarterback. If he were to be on any other NFL team, he would not be replicating this kind of success. It's all system. And that's pretty much everyone's argument against any quarterback that they do not like. If it's Tom Brady, if for me it was Peyton Manning, Aaron Rodgers, any quarterback that you don't like, you'll say, oh, well, it's because of the system. If you put any old quarterback back there, if you put Ryan Tannehill in the New England Patriots system, if you put Josh Allen in Baltimore system right now, oh, they'd be throwing up MVP-like numbers. And no, they wouldn't, okay? Because, look, if you're running an NFL franchise, any kind of franchise in any sport, whatever mentality you have as a coaching staff, whatever system that your team runs, don't you want the best personnel for your system? Like, yes, obviously, Baltimore's run first, run heavy, run often formula is going to benefit someone like Lamar Jackson. But if you're running that system, what other person would you want at quarterback? The system should dictate the personnel. And the personnel should coincide with the system. So you have this run heavy, run often, run with the quarterback, and run options and triple options and all these funky formations that the Ravens are doing. You got to have quarterbacks and running backs that agree with it. And clearly, Mark Ingram, Lamar Jackson, they're doing just fine. Mark Andrews, the tight end, he's fitting perfectly into the system. So what does this have to do with investing? So what are your goals? What is your end goal, right? How many times on this podcast have I brought up what are your end goals? What is the purpose of your investments? What is the ultimate drive? Total returns? Is it for income, retirement? What is it? And in terms of sports analogies, Your investment style is your system. So why is that important? Well, just like in football, where the Ravens like to run the quarterback very often, if you are an income investor, your portfolio's personnel should be income oriented. So what am I getting at here? Don't go all over the place for the sake of going all over the place. Know what type of system you are running. What do I mean? If you are into dividend growth investing, right? Let's just say you're a pure DGI person at heart, right? You just invest when you get low yield on cost, and then over time, the yield on your original cost, it just skyrockets over time because the dividend grows annually, right? They grow it every single year. They grow it relatively quickly, especially if the starting yield's low, blah, blah, blah. Let's say that is your system. You only invest in dividend growth companies. So you listen to some other guys or gals, and they suggest, hey, you should always have an index fund. You should always have a mutual fund. You should always have high yielders in your portfolio. You should always have growth stocks in your portfolios that don't even pay a dividend. And you're listening to that and you're thinking, maybe I should diversify a little bit outside. If your system is dividend growth, there's no need to dabble in other areas. Because if you're a dividend growth investor, the end goal is to essentially live off dividends buy now when they are cheap and on sale, below par value. And then the yield on cost over time is phenomenal. You essentially live on dividends that way. What is the point of adding any pieces that don't fit into your system? Well, Scott, does it have to be black and white? I mean, why can't we just dabble in little areas here, little areas there? Because that defeats the purpose of your goals. Look, if your goals are total return, that's fine. You can dabble in little areas here and there because total return takes into effect dividends and capital appreciation. You're not focused on one area. But if you are focused on one area, like I am with high income investing or dividend growth investors, or if you're in retirement and you want to live off dividends at a later age, whatever the case may be, in terms of income investing, you have to stick to your system. You can't go changing up your philosophy. So that's why when I used to create videos and I would change my portfolio very often, people would get upset with me saying, why are you doing this? Why do you change your position so much? And I always would fight back. My philosophy never changed. Just because the holdings changed, much like in football, just because the running back changed or the wide receiver changed, doesn't all of a sudden mean that I'm throwing the whole philosophy out the door. Okay? Bill Belichick, probably the greatest football coach of all time. How many Super Bowl rings does he have with Tom Brady? Look, when Tom Brady does eventually retire, you're not going to throw the entire Patriots coaching staff away, right? They're not changing the philosophy. Just like in investing, it's okay to change holdings, but don't add holdings that don't fit along with your system. Look, what is your system? Identify your system, because when you identify your goals, you have to get the right driver behind it, the right system behind it. So you have to keep in mind, when people buy a lot of individual stocks, if they're not doing it with a purpose, then they're just a stock picker. They're just like pretty much every mutual fund out there that tries to make it rich by timing these one-off equity positions. And that's how they want to make a name for themselves. It's not sustainable long-term, at least not. It's not very often that you see these hedge fund managers strike it rich off buying one or so equities. So know what your system is, stick to it, identify all of the weaknesses in it so that you can avoid the pitfalls of the system, realize what the strengths are in the system you are, and capitalize on those strengths. Remember, it's okay to change your positions if the philosophy doesn't change. If you want to change your entire philosophy, that's one thing. You're pretty much starting from scratch then. But if you know what your end goal is and you have your system, don't go grocery shopping and look at the aisles and go, ooh, I see a little index fund. I'm going to pick a little bit of that. Ooh, a little mutual fund. Let's go with some of that. Ooh, I see a little high yielder. No, just stick to the system and everything will be okay. All right, let's get on to the next segment. Let's talk a little bit about fear mongering in the market. So let's make this bullet point right off the bat, right as I get into this segment. So there's nothing wrong with being bullish in this current market environment. So look, we had the yield inversion, the yield curve inversion. There's a lot of economic recession indicators that have happened in the past 2 years during Trump's presidency. We think with the impeachment of Trump, there could be some trouble. There's all the trade talk with China, all the tariffs, blah, blah, blah. So many people project that there's going to be a recession, a correction, whatever happens, a downturn in the market in the near future. Let me just say, there's nothing wrong with believing that the market is just going to continue to go up. While there's so many negative indicators, there's a lot of positive indicators as well. Kind of like the last segment where I talked about, sticking to your system. Here I'm saying stick with your guns, okay? If you believe that the United States, are doing fine, the economy is going to continue to rise in the next couple of years, then don't let people scare you out of investing into the market. Look, I myself got a little bit rocked and my portfolio is a little bit more conservative, but I still maintain that I'm going to buy as much as possible. There's just no value in it for me right now. But if my positions do lower, just because I believe the economy is going to go down in a couple of years doesn't mean I'm not going to buy positions when they go lower and, dollar cost average for better income. All I'm saying is, look, you can't be scared to invest when you want to invest. You got to shout out the noise. You believe in what you want to believe. Look, you can listen to others for guidance and you can take some nuggets from them here and there of information that you find valuable to your own self, your own system, and your own financial beliefs. But there's nothing wrong with continuing to invest in this market. Everyone was scared, yet if you invested in the S&P like a month ago, you're doing quite well. We had a very, very nice October into November for the market overall. SPY, the S&P 500 index, is up well above 300 now. And it's been above that consecutively. 300 was kind of that what do I want to call it? That resistance zone. If you want to get into technical analysis, that resistance for the market just did not seem like it wanted to break past 300 for the SPY. It's finally up there and it's consistently up there, and it doesn't look like it's slowing down. I mean, if Trump does somehow work out a good, even a minor trade deal with China, you don't think the market is going to absolutely rejoice and skyrocket for that? Look, I don't agree with a lot of Fed decisions, and I don't agree with a lot of Trump's decisions, but I don't believe the economy is really in that bad of a shape. I mean, yes, there is a lot of debt out there, and people believe that debt will be the cause of the crisis. I mean, that's what caused the housing crisis, right? All this real estate debt, and you got collateralized loan obligations. And, debt could be a huge factor into why we go into recession. The millennial generation can't really afford to live a normal lifestyle with inflation and, lower starting wages out of college. That could be a cause. But if you look at macro factors, we're doing just fine in the economy. So if you're a believer that, the economy is going to continue to prosper for the next couple of years, there's no reason to hesitate just because other people are hesitant. There's some people, you have to realize, there's some people who have alternative motives to you. I follow a bunch of people on Twitter that are perma bears. Like, they permanently want to short the market at all times. They always believe that the sky is falling. A great example, if you follow him, it's called Gregory Mannarino. He's a self-proclaimed finance expert. he's pretty much negative on every single aspect of the market, and he's been for the past couple years. And as a result, you get smoked. You're so scared, and you buy gold. All these people who fearmonger, they just buy gold and these metals, thinking that they'll hold their value or appreciate during rough times. They have alternative motives. Just don't worry about it. It's okay. Look, even if you are wrong, you can adjust on the fly. That's the glory of it, okay? If you buy a lot of the market and the market starts to tank, it starts to go south, we start to enter in a recession, let's say it goes down 10 to 15% in like the next 3 months, and you were bullish this whole time, you were buying, it's okay. You can buy down. You can dollar cost average down. It's not the end of the world. Just don't panic and sell your assets at the top, okay? Just hold on. If you're a long-term investor, just hold on. It's going to be okay. So if you are bullish, it's not the end of the world if the market does go down. You can just dollar cost average if you hold on. If you're a believer in dividend stocks, well, then you're going to get your paydays more than likely through hard economic recession. So stay long, hold long, and don't be afraid to be bullish in what appears to be a stagnant. If you talk to the financial community on Twitter or on YouTube, or on Instagram, you get a lot of the same stuff. Everyone's kind of like hesitant. They're kind of loading up on cash. I'm kind of loading up on cash, but I'm not super on it. I'm not like only going cash. I'm not hell bent on like, oh, I can't buy now. There's no way the market's going to go down. But there's a lot of people that are just stacking up on cash right now. And if that goes against your style of investing, then why do you listen to them? It's like, yeah, they might give you a different perspective on something, but it shouldn't ultimately affect your mentality. It's kind of like me. Like I don't invest in Tesla. I'm not, Tesla's a pure growth play, so I wouldn't invest in it anyway. But I don't invest in Tesla. But I'll never understand Tesla shorts. I don't listen to them at all. Like, yeah, Tesla's financials are not ideal. Okay, I get that. They have weak cash flows to pay off even their bondholders, their immediate debt holders. But as a person, I don't understand, even if you do think a company's financials are bad, why on earth would you want a company like Tesla to go down? We need innovators like Elon Musk and Tesla to drive us forward, literally, but to propel a new movement. Everyone, the Cybertruck came out, and everyone who loves Tesla said, oh my God, it's great. And everyone who hates Tesla is like, oh, it's so ugly. And from someone who's neutral on the sidelines, I'm like, I think it's pretty cool. And I absolutely respect Tesla for taking a chance and going against the grain. I mean, Christ, what if we stuck with the Model T for over 100 years? Because, that's how we did it. You kind of... Why would you be short Tesla? That's all I'm saying. Look, if you want to short it and make a buck because their cash flows aren't what you think they are, then fine, that's it. But realize what you're doing. You're hoping that a company that is innovative and is ultimately a good thing for the United States and the world in general, more green, more sustainable resources and electricity. Realize that you are hoping that a company like that goes down the drain. Okay? That's all I'm saying. If you are bullish, then continue to be bullish. Don't let anyone get in your head. So I am thinking about an absolute crazy experiment. I love doing these experiments, right? They're interesting. People love following along and see what happens because, they're not stupid enough like me to do it themselves. So when the holidays are all over, so I wouldn't start this experiment for a little bit, but when the holidays are all over, my bank account has recovered a little bit, and maybe my waist is a little bit thinner from all of the holiday meals, I have a crazy experiment. So last podcast episode, I believe it was the last one, maybe it was 2 episodes ago, I was talking about the sports betting experiment that I did, where I bet heavy favorites that would pay only 10% yields, if I were to win, take that whole new balance and put it on another heavy favorite, get a 10% return, so on and so forth, like the compounding speed factor experiment. I would kind of want to try that with investing. And how would I do that? So a lot of these super high yielding companies, something like a Prospect Capital, ticker symbol PSEC, they're garbage. You would never hold them long term. A lot of these leverage funds, you would never hold them long term. Well, I don't want to hold them long term. So everyone kind of knows, if you're in the dividend community, dividend capture strategy, where you pretty much just buy a day before X dividend, you receive the dividend, and then you sell. Now, obviously, you don't have to hold it all the way through the payment date. As soon as it goes through the X dividend date, you can sell it. So my theory is, look, in sports betting, you could lose, right? So in my sports betting experiment, let's say I had $500, won 10%, so my account goes up to $550. I put that $550 on a team that's supposed to win a basketball game, and they lose. So you lose the entire $550 balance. With these high yield dividend capture strategies, however, you could theoretically just sell it the next day, and 99.999999999%, like, the stock's not going to go to zero the next day after the X dividend date. Now, it's going to drop based on the price of the dividend that it pays out. In theory, if a stock is trading at $10 and it's paying out a 10-cent dividend, on the X dividend date, the price of the share should be, at least start out, $9.90. So even though you receive a 10-cent dividend, the price goes $9.90, so the total return is effectively net zero, and that's what a lot of people argue, that dividends are irrelevant, right? Because it takes away from the price of the stock. But usually there's a lot of cases where that doesn't happen, the price recovers. So what if you do a dividend capture strategy with extremely high yielders, and you just keep churning it as fast as possible? So you don't necessarily stick to one stock. You do it, you sell after the X dividend date, and you keep churning. So if another high yielder has an X dividend date in 2 days, then you buy that one, and then you sell it quickly. And if there's another high yielder in 2 days, you buy that one and sell quickly. See if we can use super fast compounding speed and really high yields, and see if we can grow it. It's kind of curious. Now, is this tax effective? Absolutely hell no. This is a nightmare for taxes, but this is experimental. I kind of just want to see what happens. Sometimes you just got to break away from the minutia and have some fun. And, after the holidays, after I spend for all the gifts for the family and whatnot, have some fun money set aside and just experiment a little bit. It's kind of like what I do with sports gambling, but let's do it with the market. Yeah, I'll get, burned with taxes probably, but at the end of the day, I just kind of want to see, is something like this possible, where you just keep trading these super high yielders, just get the dividend payment, and see if we can compound high yielders extremely quickly despite the high volatility and price fluctuation due to the decrease in market price from the dividend payment. So that's an experiment that I am highly considering. Let me know if you're listening on YouTube. Let me know in the comments below if you would be interested in hearing results. I would put that on podcast. Maybe I'll do specific one-off podcasts just to give updates on that. But let me know if you're interested. So thank you if you are listening on YouTube. Thank you if you're listening anywhere. If you're listening on Anchor, Spotify, Google Podcasts, Apple Podcasts, whatever it may be. Thank you so much for listening. Hope you enjoyed this episode of the Spicy Dividend. Thank you for bearing with me if you're listening on the podcast versions through these sponsors. I can't believe that I got 2 sponsors that aren't anchors. And, so instead of making like a penny per view, I make like a penny and a quarter. Penny and a half, I should say, like not like 26 cents, like 1.25 or 1.5 cents. So thank you so much for bearing with me. I will see everyone in the next episode. Have a fantastic Thanksgiving to all my American listeners.